that you go and just create a short position on the Nifty or on the Bank Nifty. Pratik Gupta joins us now. Let's take the conversation forward. Pratik, welcome to ET Now. Thank you for joining us. Why have we hit this patch of pause? Suddenly the market has run out of energy.
Hi, good morning, Nikunj. I think, frankly, it's the valuations of the market which is causing this, in our view. When we speak to institutional investors around the world and in India, the common feedback is, yes, India's long-term economic growth prospects look very appealing, but how much of that is already priced in? If you look at the Nifty, you look at the price action and also the valuation. Valuation-wise, we're right now at about 22 times current year earnings, 19 and a half times next year's earnings. And this is despite factoring in fairly strong earnings growth of about, in our Kotak estimates, we think Nifty earnings will grow about 30% this year and 14% next year. So one is the valuation angle, that maybe even if you get a little bit of an earnings surprise, a lot of it is already factored in. And also from a relative performance perspective, India is now an outlier versus a lot of the EM markets. India is up about 12% year to date, whereas the MSCI Emerging Market Index is only up about 6%. China, Indonesia, these markets are actually flat. Malaysia is actually down slightly. It's only some of the really export-oriented economies like Korea and Taiwan, or maybe Brazil amongst the large EMs, where the markets are up about 12, 13%, similar to India. So it's really valuations, which is sort of the main concern for most investors, not so much anything else. And I think that's why you're seeing people unwilling to sell as well very aggressively, because there's the upside risk of the earnings growth turning out to be very strong. The monsoons have been good. And personally, I think there could be an upside in terms of events like privatization, or India's inclusion in the global bond indices, which haven't really fully been factored in. So that's what's keeping investors from selling aggressively. But likewise, because of the valuations, there's not enough appetite to buy a lot more now.
So what will it take for markets to go higher? If earnings, as strong earnings growth is factored in, do you think 6-8 months markets will hit a pause button and the new momentum will only start when we start talking about FY23 and FY24 numbers?
Well, actually, I think you could have a couple of things going on. On the positive side, like I said, if you have some large privatizations coming through, whether it's BPCL, Air India, or some visible progress on the LIC IPO, etc., so that could be a re-rating event for India in general. Second is India's inclusion in the global bond indices. That's another big event, which right now there is still a fair bit of ground to cover for the government. So if that happens, that could lay to rest some of the concerns which investors have about the RBI's ability to manage the bond yields and the government borrowing program. There are concerns that local bond yields could also go up quite sharply. So those are two on the positive side. But otherwise, yes, you're right. We could be sort of in a sideways market for a while. On the negative side, the biggest risk we have to watch out for is what happens with the Fed. They've already sort of signaled that this ultra-loose monetary policy will not be there forever. But on the negative side, if sometime in August, September, in the September FOMC or the Jackson Hole Summit, if they announce some kind of a tapering, that could lead to some kind of outflows out of emerging markets. Although I think we are not in the same situation as in 2013. But definitely globally, you could see an outflow from risk assets and emerging markets in particular. And in that scenario, even India will be impacted.
Pratik, hi there. Good morning. Proof really in the pudding in the way the broader markets have shaped up, particularly for the month of June. That outperformance fairly evident with a nice 5% gain for the small cap index. What's the sense that you're getting that going forward, we're going to see this resilience and optimism continue within the broader universe? And in light of this, what is it that you're advising investors to do in order to capitalize on this opportunity?
So I think you're right that this time the rally is far more broad-based, and it's also reflected in the earnings of these small and mid-cap companies. This time it's no longer just a handful of stocks or just one or two sectors which is really driving the market. It is indeed broad-based. But conversely, I would argue that the valuations of a lot of these mid caps have become quite expensive. We would actually advise caution. If you look at the mid cap index, it's up about 25% from the previous peak in 2017. And a lot of these stocks are even trading at a premium to their large cap peers in the same sector. And within mid caps, you have the sector leaders within some of the smaller sectors, let's say, real estate, chemicals, bearings, consumer durables, and so on, where the prospects may be very good, but valuations have become quite stretched. So our preference right now is, unless you've got a really long 4 or 5 year time horizon, you're willing to wait out maybe a period of underperformance or maybe even a correction in some of these small mid caps. These are all generally, many of them are very good businesses. But our preference right now would be more focused on the large caps, where we find the relative value far more attractive in the large caps in particular.
What about betting on financials as a space? Do you think that it would be a prudent strategy to look at some of the marquee large cap names, or would you extend it to the entire basket like NBFCs, the PSU banks, as well as insurance plays, etc.?
So within financials, firstly, actually financials, yes, that is our preferred way to play the economic recovery in India, not just from the perspective of the strong earnings outlook, given that we expect credit costs will come off, will stabilize this year in the case of a lot of the private banks and even the PSU banks. Next year, I think hopefully you'll start seeing credit growth also picking up. So that should lead to a fairly strong earnings outlook for both FY 22 and 23, and hopefully 24 as well. Asset quality issues are behind us. But I would in general say that we should look for banks which are more of a play on the corporate sector, corporate loan recovery, rather than the MFI or the SME-focused banks, where you will probably still see continuing issues in terms of asset quality or loan growth. So that's point one. In general, also, I would argue that we should look at more of the large cap private banks rather than the mid cap or small cap ones. When the economic recovery really gathers momentum over the next 6 to 12 months, as we expect, it is these banks which have a very strong liability franchise, low cost of deposits, and their technology platforms are far more developed. They will actually be far better positioned to capture the opportunity versus some of these smaller banks, which are in some cases still struggling with their asset quality issues, or they're not well capitalized, or the systems are not as well geared up to capitalize on the upturn. So that's as far as the banks are concerned. NBFCs, I think you have to be a bit selective. Again, I think the large NBFCs, they should do well in our view, especially the ones which are well capitalized or have access to capital from their parent organizations, and where the asset quality issues are behind them. So there are some of the NBFCs which will benefit. Insurance also we like, but insurance typically is a lower beta play on the overall economic recovery cycle. So our preference would be the large cap private banks, then some of the better quality NBFCs, and then maybe the insurance companies. As far as PSU banks are concerned, other than the 1 or 2 large PSU banks, in general, we would still be cautious. While there is an economic recovery underway, while on a headline basis, these stocks appear cheap, trading at 0.4, 0.5, 0.6 times price to book. But bear in mind that their ROEs are still likely to be barely 6, 7, 8% over the next 1 to 2 years. And in many cases, you will see a massive equity dilution as well below the book price for these banks to maintain their capital adequacy. So our preference still remains with the private banks in general, barring 1 or 2 of the large PSU banks.
Earlier, alluding to real estate as a sector, do you not believe that a large part of the prognosis for realty to continue to see strong growth depends on interest rates being low for a long foreseeable time? Or is that an assumption that you are making?
No, I think you're right that interest rates will eventually move up, maybe by the end of this year or early next year. We do expect rates starting to go up. Next year, we could see a 50 to 75 bips increase in interest rates. But having said that, despite that kind of an increase, we think the demand for real estate is still pretty strong, especially post-pandemic, as you've seen and heard from various real estate players and various consumer forums, etc. A lot of people do want to upgrade and add that extra bedroom into their house and move to a bigger place. Because of the pandemic, the desire to own a house, a bigger house, is definitely there. Combine that with the low interest rate environment we have right now, and even if the rates move up by 50 to 75 bips over the next 1 year, I think affordability is still very good, and you will see very, very strong demand for residential real estate in particular. I think on the commercial side, there could still be some challenges, but on the residential side, I think the outlook is still very, very strong. And bear in mind, a lot of the listed companies in the real estate space have also paid down a lot of debt. They're deleveraging quite aggressively, and they're not sort of investing in building up land banks and so on. Most of them, the general management strategy is to use the cash flows to pay down debt, which makes these businesses a lot less risky versus where they were, let's say, 5-10 years ago. And we're at the upturn of we're hopefully at the beginning of a real estate upcycle. So the residential plays actually look quite good.
While last year, Pratik, was about disruption in IT and technology, this year it seems it's going to be autos. And while, EVs have been much talked about for a while to come, it seems that, sooner or later, India as well is going to be hit by the wave. Where within autos do you find opportunity to try and bet on the EV play? Or do you think it would be from the ancillaries, the battery makers and what have you, that one needs to play this EV cycle?
I think you're absolutely right as far as the auto sector is concerned, as far as the existing incumbent OEMs are concerned, or even the ancillary companies, you have to watch out for the EV risk. Two-wheelers, for example, you have a large competitor coming up in the form of Ola, which is setting up a massive capacity. They're funded by private equity, so they could be quite disruptive. And that's just one example. There could be many others. This is not to say that the incumbents are just going to sit back and watch their market share being taken away, but the competitive intensity in the industry is likely to go up. The way we look at it is we actually, at current valuations, we actually prefer more of the tractor companies where we think the risk coming from EVs is relatively lower, and also the growth outlook, the penetration levels are low, so therefore the growth outlook is quite strong. And second is the export-oriented two-wheelers, where again, it's more of a market share gain story. Our Indian companies have generally beaten their Chinese and Japanese counterparts, and there's the demand outlook over there is extremely strong. And third is I would then also look at the commercial vehicle segment, where as the economic recovery progresses, as the capex cycle in India starts kicking in, as government activity on infrastructure projects starts picking up post-monsoons, we think some of the CV players will also do well, but that's probably more a quarter or two down the road.
I'm buying cement because cement companies are reducing debt. I like sectors where companies are reducing their leveraging because of high commodity prices and new growth cash flows. So my question to you is that if big corporates are reducing at deleveraging the balance sheet, whether it is Reliance or Tata Group of companies or even Birla Group of companies, why should one buy into corporate banks? Because if the top 3-4 corporates are deleveraging, then where will the growth in credit come from?
Nikunj, you're right. This is a phenomenon, I think, more relevant for the current financial year, FY22, where the credit growth outlook is not very strong. Most of it is going to be, maintenance capex or for working capital requirements. But this year, the growth in the bank's earnings will come more from a sharper decline in their credit costs, and in some cases, much better NIMs, although we think NIMs are probably peaked out and will not improve too much further from here on, given that deposit rates are no longer falling anymore. But I think the reason why we're seeing banks is, A, because we do expect credit growth to pick up next year as the capex cycle starts picking up momentum. Bear in mind that while we are seeing deleveraging, we are also beginning to see a lot of companies announce fairly aggressive capex plans in the steel sector, aluminium, fertilizer, chemicals, pharmaceuticals, and so on. And also a lot of the MNCs are coming into India as well. But one is the outlook for credit growth going into next year. And second is from a valuation perspective, especially in the large cap space, this is one sector where valuations are still somewhat reasonable compared to some of the other sectors which are out there in terms of price to book multiples and the ROE outlook. So that's why I think despite the near-term concerns about credit growth, I think that's more of a passing and a temporary phenomenon. We think once the economy starts picking up, you will start seeing a very strong pickup in credit growth from next year onwards.
HDFC Group of companies as an example here, Pratik, and I'm not inviting you to talk about your outlook on HDFC Limited or HDFC Bank. I'm using them as a group. HDFC Group of companies are underperforming. Is that because markets are saying that, look, get outside the comfort of high growth, high valuation?
Well, I think it's also a case of some of the other banks sort of cleaning up their books, raising capital, asset quality is no longer an issue. So people are finding alternatives. I don't think it's a case of the high quality banks sort of not being a favorite anymore. On the contrary, I think these still remain pretty significant positions for a lot of our global as well as domestic investors. But I think when the time comes, as and when the credit growth cycle picks up, it is these larger banks which have the lowest cost of deposits because of the very, very strong liability franchise. The CASA ratios are very high, and they have the connections, relationships with the large corporates, and they can meet their size requirements. They will actually be the ones who will probably benefit early on. So I think it's a bit too early to write off some of these higher quality institutions just because right now credit growth is a bit weak. But I think let's give it some more time.
Okay, and Pratik, give us a sense as to what exactly your outlook is on, giving investors advice on creating wealth, getting rich, accumulating money, and compounding their wealth.
So I think on that one, I would say first and foremost, don't be overly greedy. Investing is a very, very long-term game. You have to have a minimum of, in my personal view, depending on the investor's age, at least a 5 to 25-year time horizon. The longer, the better. Look for compounding stories. Don't look for the next multi-bagger. So that's advice number one. And second, I think equally importantly, I think it's very important to do your research properly and don't make mistakes. A lot of investors, in their sort of excitement to make wealth quickly, they end up making suboptimal decisions without doing proper research. So I think the most successful investors are also those who make the fewest number of mistakes or no mistakes. So making fewer mistakes and having somewhat of a mediocre return may still end up being better than having 2-3 multi-baggers, but then you have 2-3 other stocks where you are down 70, 80, 90%. So that's number two. And third, I think investing just in general, we've seen that focus on corporate governance. That's a very important factor. In the long term, companies with good corporate governance, those are the stocks to invest in, the business and management and so on. That all comes part and parcel of investing, but also pay extra attention to corporate governance.
All right, Pratik, pearls of wisdom, and thanks very much for sharing with us your outlook on the equity markets. It's been great having you on board.